Labor cost variances. In this session, we are going to learn how to calculate variances for the labor cost. So before we proceed towards the calculation of labor cost variances, first of all, a quick reminder, what do we mean by the variances? So variance is the difference between a planned, budgeted or standard cost and the actual cost incurred. So when we compare the standard cost with actual cost, the difference is called as the variance. And the same comparison can be made for the revenues as well, which we will keep it for a different session. Now, variances are calculated in total using flexed or flexible budgets and then broken down further into labor efficiency variance and labor rate variance. Or alternatively, which is more easier way, we can calculate the labor efficiency variance and labor rate variance, and then we can combine these two together to get the total labor cost variance. So let's have a look at the pro forma for the labor cost variances. So the standard pro forma is divided into three lines which are very easy. Always remember, first of all, we have the standards. So like these are the standards. Okay, standard hours into standard rate. And at the end, what we get is the actuals. Okay, actual costs or actual rate. So standards are standard hours into standard rate, actuals or actual results will be actual hours into actual rate. And then this middle line is developed from the left hand side when we change standard hours to the actual hours without touching the right hand side. So now the difference between line number 1 minus line number 2 gives us the efficiency variance, which actually determines whether the job completed has taken more than the standard hours or less than the standard hours. Then line number 2 is compared with line number 3, in which we actually compare standard rate and the actual rate to reflect whether we have paid our workforce above the expected rate or less than the expected rate. Okay, so the pro forma standard hours into standard rate, which is compared with actual hours into standard rate, and the difference is called as the efficiency variance. Okay, and as far as the standard hours are concerned, standard hours are calculated as standard hour per unit into actual units. The reason being is this: in the questions, we are always given standard hours for 1 unit, whereas the actual results are given for 100 or 1000 or even tens of thousands of units. So in order to compare like with like, we flex the first line by multiplying the standard hour per unit into the actual units produced. And then all our data is in a comparative terms. Then the actual hours into standard rate, which is the second line, is compared with actual hours into actual rate, which is always given, and the difference is called as the rate variance. But it is all theoretical. Let's have a look at the question. Okay, so here is one imaginary company which has the standard results of direct labor that 1 unit takes 3 hours and the labor gets paid $10 per hour. Actual results were the company produced 2000 units of actual output and the hours paid and worked for these units were 5500 hours costing $61,000. Calculate all possible variances. So first of all, the pro forma, standard hours standard rate, actual hours standard rate, and actual hours actual rate. Let's fill in the pro forma. Okay, here goes. First of all, standard hours, which are given in the question, that 1 unit takes 3 hours and we actually produce 2000 units. So the standard hour in the first line, SH, will be 6000 hours. Times by the $10 standard rate given in the question equals to 60,000. Now the actual hours were given 5,500 times by $10 per hour, which if we multiply that, we get $55,000, and the difference is called as $5,000 of favorable variance. So if the answer is positive, it is favorable, but it's not just being positive. If you compare standard hours to complete 2,000 units for 6,000, whereas the actual job took only 5,500 hours. So it means the job was completed 500 hours quicker. That's why efficiency of the workforce was favorable. Okay, now we are going to compare the actual hours into standard rate with actual hours into actual rate, which was given actual cost. And the difference is minus $6,000, which is adverse. And it's not because it is adverse. Look at that. Standard rate is $10 per hour. So if I take you back into the question, and here is the data. Now look at that. 61,000 hours costing 5,500 hours costing $61,000. So if I divide 61,000 $61,000 over 5,500 hours, so it is telling me that we actually paid workforce an average rate of 11.09 per hour, which is more than the standard rate, and therefore it is adverse, which is reflecting the overspending. Okay, so that was 6,000 adverse. Now if we combine the efficiency and rate variances, we get the total labor cost variance like this. Remember, efficiency was $5,000 favorable and rate variance was $6,000 adverse, and combining them gives us $1,000 adverse, which simply reflects we probably try to save money on the we try to spend more money on the labor rate variance by hiring better skilled workers, and because of hiring better skilled workers, it ended up giving us better efficiency. So no doubt we did pay more to the workforce than expectation, but they did a good job by completing it quicker. So therefore the total variance was no doubt $1,000 adverse, but of course we will have to check what was the impact of this on the product quality and the revenue generation before we actually see whether it is overall good for the company or it did not serve in the best interest of the organization. Thank you.